So good morning, everyone, and welcome to the week 3 review session. So starting from this week, I will be the one who leading the weekly session. And my goals for the sessions are twofold. So firstly, making the session a complementary to professor's lecture in a way that applying the knowledge, the concepts we learn from the week in solving actual questions. So mostly we will cover the wrap-up quiz question. However, if I found some of the question from the Get Started module that is frequently missed by the class, I will also discuss that in our session. And secondly, I would like to incorporate my own learning experience as an undergraduate student. So at some point, I will emphasize some of the concepts I feel confused when I first learned the concepts, and then explain it in a simple and straightforward way that I wish I could know when I first learned it. So having said that, the plan for each week is that I will first go over some of the most important concepts of the week, and then we go over each wrap-up quiz questions. At the end of the session, I will leave some time for any questions you may have. Also, if you have any suggestions for me or for the session that can better help you learning the material of the class, feel free to let me know, and I'd be happy to incorporate that in our next session. So after each session, I will post both of my slides and the recording to Canvas and to the discussion forum for your future reference. Okay, so let's jump into today's material. Can you see my shared screen? All right, I think it works now. So the first pair of concepts I want to cover is primary market versus secondary markets. So the primary markets are the markets where new securities are issued and sold for the first time, whereas the secondary markets are the markets where previously issued securities are bought and sold. The purpose for the primary market is to raising capital for issuers, such as companies or government. However, the secondary markets providing liquidities to the investor, and it can pricing the securities. So from the different purpose of the markets, the participants are obviously different. Both issuers and investors participate in the primary market, whereas only the investors, the buyers and sellers participate in the secondary markets. So the activities involved in the primary markets are initial public offerings or private placements, and the activities in the secondary markets are just transactions that occurs on exchanges or over the counter. The key difference here to remember is that primary markets involves direct transactions between issuers and investors, whereas the secondary markets has no direct involvement of the issuing companies. Only the investors participate in the secondary markets. All right, so the second pair of concepts I'd want to cover is market order versus limit order. So the market orders are orders that to buy or sell a security immediately at the best available price. So by the word immediately, we can tell the market order guarantees execution, but not the price, because the market price are changing continuously. And the purpose of market order is to use when execution speed is preferred and is more important than the price of the execution. An example could be buying a stock at the current market price, which is the best available price at the market. And the limit order is an order to buy or sell a security at a specified price or better, which guarantee the price but not the execution. The purpose is to use the limit order when price is more important than execution speed. So one simple example is to set a limit to buy a stock only if it drops to $50. The risk involved in the limit order is the order may not be executed if the market doesn't reach the limit price. All right, the third concept I want to discuss is trading on margin. So trading on margin is a technique that involves borrowing funds from a broker to purchase securities using your existing portfolio as collateral. So how does it work? The investor first deposit a margin or a percentage of the total trade value with a broker, and the brokers then loans the investor the remaining amount that needed to complete the trade. Two important concepts involved in the trading on margin. The first one is margin requirement, which is the minimum amount an investor must maintain in their account as equity. And a margin call is a broker's demand for additional funds if the account equity falls below the required level, which means if the equity amount falls below, the brokers will initiate a margin call to require additional equity from the investor. All right, so that's the brief review. So let's jump into the questions we have for the week. Question 1 is about leverage ratio. An online brokerage firm has set the minimum margin requirement at 55%. What is the maximum leverage ratio associated with a position financed by this minimum margin requirement? So firstly, we need to be very clear about what is a leverage ratio. So it is simply equal to the total position value divided by equity. And we can use the following formula to find the relation between the minimum margin requirement and the maximum leverage ratio. So the maximum leverage ratio is just equal to 1 over the minimum margin requirement. So plugging the number 55%, we can get the final result, which is 1 over 0.55 equals to 1.82. All right, so the second question is about order types and the concept of bid price and ask price. So we have a couple of true-false questions. The first statement, an investor who wishes to sell shares immediately should ask his or her broker to enter a limit order. So from our previous review, we can know that this statement is obviously false because an investor who wishes to sell shares immediately should ask the broker to enter a market order, not a limit order, because a market order ensures the immediate execution at the current market price, but the limit order will only ensure the execution price, but not the speed. Okay, so the second statement, the ask price is less than the bid price. This is also false because the ask price represents what sellers are willing to accept, while the bid price represents what buyers are willing to buy. So intuitively, the sellers want to sell the asset as high as at a price that is as high as possible, whereas the buyers want to buy the asset as low as possible. So the ask price is greater than the bid price. The third statement, an issue of additional shares of stock to the public by Microsoft would be called an IPO. So we know that an issue of additional shares of stock to the public would be called a seasoned offering, not an IPO. The IPO is initial public offering, which refers to when the first time the shares are issued to the public. And all the following issuance of shares are called seasoned offering. Okay, so the last statement. An electronic communications network is accessed by a computer link used by security dealers primarily to advertise prices that they are willing to buy or sell shares. So this is the one of the function of the ECN, which is price quotation. So one thing to know that an ECN is both a price quotation system and a true trading system. An ECN allows participants to post market and limit orders over computer networks. This will enhance the market transparency and efficiency. So this statement is correct. So we move to the third question. It is also a true-false question. The first statement, market orders entail greater price uncertainty than limit orders. We know that the market orders are executed at the best available price, which can change frequently due to market conditions. So this can create greater price uncertainty compared to limit orders. We know that the limit orders only will be executed at a specified price by the investor, so it has less price uncertainty. This statement is true. And the second one, market orders entail greater time of execution uncertainty than limit order. This statement is false because market orders are designed for immediate execution, meaning that there is less time of execution uncertainty. In contrast, limit orders may not execute it immediately, only if the price meets the specified limit. The limit order will be executed. So the key things to keep in mind is that market order emphasize the speed of execution, but limit order will only be executed when the price reach the specified limit. So it prefers the price versus speed. All right, so we move to the question 4. Question 4 to 7 shares the same problem setup, but it are examined from different angles of trading on margin. The question is as follows. Rob opens up a brokerage account and purchases 300 shares of Internet Dreams at $40 per share. He borrows $4,000 from his broker account to help pay for the purchase. The interest rate on the loan is 8%. What is the margin in the account when he first purchases the stock? Firstly, we need to be very clear what is a margin. We can just consider margin as the net worth or equity value of the amount. And we then calculate the total share purchased. We can use the 300 shares times the dollar per shares, which is 300 times 40, which is $12,000. And the amount borrowed by the investor is just 12,000. It's just $4,000, which is given by the question. And the margin in the account equals to the total stock purchased minus the amount borrowed. Plugging the numbers here and here, we get the final answer, $8,000 of equity. So that's the margin amount. All right. And question 5, we have an additional information, which is if share price falls to $30 per share by the end of the year, what is the remaining margin in the account? So for this question, we first calculate the new total value of the stock using the price by the end of the year. So we can see that the 3,000 shares we buy times the $30 per share by the end of the year, we can get the $9,000 of new stock value. And next, we compute the amount of the loan with interest. So the investor borrows 4,000, which we use the number to times 1.08. We can get the number of loan with interest, which is $4,320. The remaining margin in the account is equal to the value of new stock minus the loan with interest. Plugging those two numbers, we can get the final answer of $4,680. Right. So this one is quite similar to the previous one. We just need to be clear of the amount of the loan with the interest. Next question. So this one asks for the maintenance margin. Remember, it is the minimum level of equity in the account the broker requires from the investor. So we have the information here. The maintenance margin requirement is 30%. So we are asked if the investor will receive a margin call or not. From the previous question, we know the new stock value by the end of the year is 9,000, and the loan with interest is this amount. Also, the margin we have got from the previous question is $4,680. So we can easily compute the percentage margin, which equals to the margin amount divided by the new stock value we have by the end of the year times 100. So the percentage margin is equal to 52%. The next step is that is very important. We need to compare the maintenance margin level with our percentage margin level. Because we know that 52% is greater than 30%, the required maintenance margin level. Therefore, no margin call will be issued by the broker. All right, if no questions, I will move to the next one. So this question asks for the rate of return on the investment. We know that the rate of return equals to the gain or loss on the investment divided by the initial equity investment. So we first calculate the gain and loss on the investment. From question 4 and question 5, we have the total stock purchased, which is equal to the $12,000. And the new stock value by the end of the year is $9,000. So the loss in the stock value is the difference between these two numbers which equals to $3,000. And the interest cost is we use the amount borrowed times the interest rate, which is $320. So we can easily compute the total loss of investment using the loss in the stock value plus the interest cost, which is this number, $3,320. Next, we remember from question 4, we get the initial equity investment, which is the margin amount, $8,000. So we can easily compute the rate of return using the total loss divided by the initial equity investment. Because the loss is a negative number, we add this negative sign before the total loss. So plugging numbers, we get the rate of return of investment equals to negative 41.5%. All right, question 8, which is also asking for the concept of margin. Now we have some additional informations. Old economy traders opened an account to short sell 1,000 shares of interest streams from the previous problems in a margin account. The initial margin requirement was 50%. The margin account pays no interest. A year later, the price of Internet Dreams has risen from $40 to $50, and the stock has paid a dividend of $2 per share. We are asking, what is the remaining margin in the account? So there is a new concept, short sell. So which means that the investor does not own the share at first, and he or she just sell the shares and then buy the shares back when the price drops, so the investor can benefit from the price difference. To solve this question, we first need to compute the initial margin. So we have short sell 1,000 shares, and we use this number to time the $40 per share, the price per share, and we use this number to time the minimum margin requirement, which is 50%. So we got the initial margin amount, $20,000. So next step is to calculate the loss due to the stock price increase. We know that the price changes from $40 to $50. So the price difference is $10. We use that to times the short sell shares amount, which is 1,000. We get the loss in price increase, which is $10,000. And the dividend payment to the lender, because we know the dividend is $2 per share, we use that times the total shares amount and get a $2,000 dividend payment. All right, so the final step is to calculate the remaining margin in the account. We use the initial margin to minus the loss in stock price increase and the dividend payment. So plug in the above three numbers, we get the final answer of $8,000, which is the remaining margin. in the account. All right, so the next question is about another order type, which is a stop sell order. We can think of it as a order that it triggers a market order to sell the stock when its price falls to the stop price, $55 in this case, or below that price. So the question is asking if you place a stop sell order to sell 100 shares of stock at $55 when the current price is $62, how much will you receive for each share if the price drops to $50? We know that for a stop sell order, once the stop price reaches $55 or below, the stop sell order is executed as a market order. So a characteristic of market order is that it will be filled at the best available market price. So it will the market order could be executed at any price depending on the market condition when the order is executed. Therefore, there is uncertainty in price related to the stop sell order. Since the stop sell order executed at the market price once it is triggered, it is uncertain what price the investor will receive for each share when the price drops to $50. So this question itself is not difficult, and I want to make a quick note here about the difference between stop orders and limit orders. So the stop order is an instruction to trade when the price of a market hits a specific level that is less favorable than the current price. So we can see from the below graph, if we are placing a buy stop order, the order will be placed above the price of the current market price, and the price is keep going up. And if we are placing a sell stop order, the order will be placed below the price of the current market, below the current market price, and the price is keep going down. And limit order is an instruction to trade if the market price reaches a specified level or more favorable than the current price. So we can see from the below graph again, the buy limit order will be placed below the price, and the price then goes up. And the sell limit order will be placed above the price, and the price then goes down, which is shown as the graph below. So the purpose of the investor who placed a stop order, if he placed a sell stop order, is is due to loss aversion, because the price of the asset keeps going down. He wants to minimize his loss. So if the price keep going down, he wants to sell this asset at some point. All right, and let's move to, oh, there's a question in the chat. If the market progressively goes down to $50, why would it not sell at $55? Okay, so you're asking for the stop sell order, right? Okay, so the reason here is that the investors may not anticipate the price will go down in the future period. Maybe it's anticipate the price will keep going up, but the price is unexpectedly going down. So he want to stop his loss at a price of $50.